Someone just bet $9.5 million that silver is going down. They did this after already losing $4.79 million on the exact same trade. Let that sink in for a second. This is not a typo. This is not a joke. This is a real trader with a real position that we can track on-chain, and they are absolutely determined to short silver into the ground, no matter how much money they lose doing it. I'm Mr. AG, and today we need to talk about what is happening in the silver market, because this story is way bigger than one stubborn trader losing millions. What we are witnessing right now is a collision between someone betting everything on silver crashing and a market that is facing the most severe structural supply deficit in decades. One of these forces is going to break, and when it does, the move could be absolutely violent. Now let me walk you through exactly what's happening, because the details here matter more than the headlines. According to blockchain monitoring data, there's a wallet address that traders have nicknamed the Silver Squeeze Air Force, and yes, that's a real name they're using. This address has become infamous for one thing: stubbornly, relentlessly, almost obsessively shorting silver no matter what the price does. Their current position is a 20 times leveraged short on a silver synthetic asset worth $9.5 million. The average entry price is $83.73 per ounce. And as of the latest data, they're sitting on an unrealized loss of $272,000. But here's the part that should really get your attention. This same trader held a previous silver short position for several days. That position was closed. The realized loss on that single trade was $4.79 million. Let me say that again. They lost nearly $5 million betting that silver would go down, and their response was to immediately open an even bigger short position at a similar price level with the same 20 times leverage. This is either someone who knows something the rest of us don't, or this is someone who's about to learn an extremely expensive lesson about fighting a structural trend. Now, here's the framework I want you to keep in your head as we go through this video. Markets are not random. They're driven by supply and demand. When there's more demand than supply, prices go up over time. When there's more supply than demand, prices go down over time. Everything else, the leverage, the speculation, the short-term volatility, all of that is noise layered on top of the fundamental reality. So the question we need to answer is simple. What does the fundamental reality look like for silver right now? And the answer might shock you. Silver has been in a structural deficit for 5 consecutive years. That means for 5 years in a row, the world has consumed more silver than it has produced. This isn't a temporary imbalance. This isn't a one-off event. This is a persistent, ongoing trend that is depleting the world as above-ground stockpiles at a rate we haven't seen since the 1970s. Let me give you the numbers because they tell a story that most people don't understand. In 2022, global silver mine production was approximately 822 million ounces. Total demand was over 1 billion ounces. The deficit was 208 million ounces. In 2023, production was around 835 million ounces. Demand was just over 1 billion. The deficit was 180 million ounces. In 2024, production dropped to approximately 813 million ounces, while demand remained around 995 million ounces, another deficit of 182 million ounces. And the projections for 2025 and beyond show more of the same, deficits in the range of 180 to 185 million ounces annually. Now here's the cliffhanger you need to understand. Where does the silver come from to fill those deficits? It comes from existing stockpiles. It comes from inventories that have been built up over decades. And those inventories are getting depleted fast. Exchange-registered inventories across major trading hubs have declined by approximately 65% since 2020. The London Metal Exchange is down 72% from peak levels. The Shanghai Futures Exchange is down 58%. COMEX in New York is down 68% from 2020 levels. This is not a drill. This is not fear-mongering. These are the actual numbers from the actual exchanges where silver is traded and stored. And the trader nicknamed the Silver Squeeze Air Force is betting $9.5 million that all of this doesn't matter. They're betting that silver is going to crash despite a fundamental supply crisis that has been building for half a decade. Now let me explain why silver's supply problem is so unique and so difficult to solve, because this is the part that most people completely miss. Silver is not like other metals. When gold prices rise, gold miners can increase production to capture the higher prices. When copper prices rise, copper miners can expand operations. Supply responds to price signals. That's how commodity markets are supposed to work. But silver doesn't work that way. Approximately 78% of annual silver production comes as a byproduct of mining other metals. Silver isn't the main product. It's the side product. It comes out of the ground when miners are digging for lead, zinc, copper, and gold. This creates a fundamental disconnect between silver prices and silver supply. When silver prices go up, The primary metal miners can't just produce more silver unless they expand their entire operations, which takes years of planning, billions in capital, and regulatory approvals that can drag on for a decade. Conversely, when demand for base metals like copper and zinc declines, silver production falls regardless of how high silver prices go. The silver supply is held hostage by the economics of other industries. Only about 21 to 23% of silver production comes from primary silver mines, operations where silver is the main product and where supply can actually respond to price signals. That's a tiny fraction of total output. And here's what makes it even more challenging. New silver mining projects take 7 to 14 years from discovery to full production. That's the timeline for exploration, feasibility studies, permitting, construction, and ramp-up. Even if silver prices doubled tomorrow, you wouldn't see meaningful new supply for the better part of a decade. So when someone opens a massive leveraged short position betting that silver is going to crash, they're essentially betting that this structural reality doesn't matter. They're betting that somehow, magically, supply is going to materialize out of thin air to crush prices. And based on everything we know about how silver mining works, that bet looks increasingly desperate. Now let me talk about the demand side, because this is where the story gets even more interesting. Silver demand is not just about jewelry and investment. Silver is an industrial metal with applications that are growing rapidly and that demonstrate remarkable price insensitivity. The solar photovoltaic industry has emerged as silver's largest growth sector. Solar panels require silver paste for electrical contacts because of silver's superior conductivity and resistance to oxidation. There's no substitute that performs as well at scale. Currently, the solar industry consumes approximately 130 million ounces of silver annually. That's roughly 13% of total global supply, going to just one industry. And here's the projection that should blow your mind. As the world pushes toward decarbonization and renewable energy targets, solar installations are expected to surge. Industry projections suggest solar capacity could reach 2,500 gigawatts globally by 2030, potentially driving silver consumption to over 200 million ounces from solar alone. A study published recently projected that total silver demand could reach 48,000 to 54,000 tons per year by 2030. But supply is expected to rise only to about 34,000 tons. That means only 62 to 70% of demand would be met by production. The solar sector alone could consume up to 41% of global silver supply by the end of the decade. Now layer in electronics, 5G infrastructure, electric vehicles, medical equipment, and water purification. Each of these applications treats silver as essentially irreplaceable because substitutes either lack sufficient performance or prove economically prohibitive at scale. Modern electric vehicles contain 25 to 30 grams of silver compared to 15 to 18 grams in conventional vehicles. Every single EV that rolls off the production line increases silver demand. Every 5G base station requires silver-intensive components. Every solar panel installation locks up silver that doesn't come back to the market. And here's the key insight. Industrial silver demand demonstrates remarkable price inelasticity. That means demand does not drop significantly even when prices rise, because silver represents less than 2% of final product costs in most applications. Manufacturers can't switch to alternatives without extensive testing and certification that takes years. So you have supply that can't respond to prices because of the byproduct structure. And you have demand that won't respond to prices because silver is technically irreplaceable in critical applications. That's the structural reality facing the trader who just bet $9.5 million that silver is going down. Now let me address the psychology of what's happening with this short position, because I think it reveals something important about market behavior. This trader has already lost $4.79 million on a silver short. That's a catastrophic loss by any standard. Most traders would step back, reassess their thesis, and ask whether they might be wrong about something fundamental. Instead, this trader immediately opened an even larger position with the same directional bet and the same aggressive leverage. This is either conviction or stubbornness. And in markets, the line between those two is very thin. There are scenarios where shorting silver makes sense. If the global economy enters a severe recession, industrial demand could fall sharply. If the dollar strengthens significantly, that creates headwinds for commodities priced in dollars. If the Federal Reserve maintains higher rates for longer than expected, that affects the opportunity cost of holding non-yielding assets like precious metals. But here's the problem with the bearish case. Even in recession scenarios, the structural supply deficit doesn't disappear. Mines don't suddenly produce more silver because the economy slows. If anything, base metal production might decline, which would reduce silver byproduct supply even further. And on the demand side, industrial applications for silver are tied to megatrends that transcend economic cycles. The world isn't going to stop building solar panels because of a recession. Countries aren't going to abandon their clean energy targets. The electrification of transportation isn't going to reverse, so the bearish case requires you to believe that short-term cyclical factors will overwhelm long-term structural forces. And based on 5 consecutive years of deficits and rapidly depleting inventories, that belief is getting harder to justify. Now let me talk about the gold-silver ratio, because this is another piece of the puzzle that makes the short position look increasingly questionable. The gold-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Over long stretches of history, this ratio has averaged somewhere between 50 and 60. In earlier monetary eras, the ratio was often fixed by governments at values like 15 or 16 to 1. In recent years, the ratio has traded at historically elevated levels, sometimes above 80 or even 90. That means silver has been cheap relative to gold by historical standards. When the ratio is stretched to extremes, it tends to eventually revert toward historical averages. And when that reversion happens, it typically occurs violently. Silver doesn't politely catch up to gold, it overshoots, it runs. It makes moves that seem impossible until they're happening. Traders who follow this ratio see it as one of the most asymmetric opportunities in the precious metal space. If gold simply maintains its value and the ratio compresses toward historical norms, silver could outperform dramatically without needing any new catalyst. The trader shorting silver is betting against this mean reversion tendency as well. They are betting that silver will continue to underperform gold despite the ratio already being at historically stretched levels. Maybe they're right. But history suggests they're fighting a powerful force. Now let me talk about what happens if this trader gets liquidated, because that's the scenario that could accelerate silver's next major move. A $9.5 million short position with 20 times leverage means the notional exposure is massive. If silver moves against this position by a certain percentage, the losses escalate rapidly. And at some point, if prices rise enough, the position faces liquidation. Liquidation of a large short position means forced buying. The trader has to buy back the silver contracts they sold short, regardless of price. And in a market with thin liquidity and depleted inventories, that forced buying can create a cascade. Other shorts see the liquidation. They worry about their own positions. They start covering, which creates more buying pressure. Momentum traders see the move and pile in. And suddenly, what started as one trader getting liquidated turns into a broader squeeze. We've seen this pattern before in various markets. Short squeezes can be violent because shorts are forced buyers at the worst possible time. They have no choice. And when the underlying market has genuine supply constraints, the forced buying can push prices far beyond what anyone expected. I'm not saying this will definitely happen. I'm saying the setup exists. A large, stubborn short position combined with structural supply deficits and depleted inventories creates the conditions for exactly this kind of move. Now let me step back and talk about the broader market context, because silver does not trade in isolation. We're in a period of extraordinary macro uncertainty. Central banks around the world are navigating inflation, growth concerns, and debt sustainability challenges simultaneously. The Federal Reserve is sending mixed signals about the path of interest rates. Geopolitical tensions remain elevated. Trade policies are shifting. In this environment, precious metals serve as hedges against multiple risks. They hedge against currency debasement. They hedge against inflation. They hedge against systemic financial stress. They hedge against the unknown unknowns that seem to keep materializing. Gold has been making new highs as central banks accumulate and investors seek safety. Silver, as the more volatile sibling, typically follows gold, but with amplified moves in both directions. If gold continues higher, and the macro environment remains supportive for precious metals, silver has significant catch-up potential. The gold-silver ratio compression alone could drive substantial gains, even without any new bullish developments. But if the macro picture deteriorates in specific ways, if we get a deflationary shock that crushes industrial demand, if the dollar strengthens dramatically, then the short thesis gains more merit. That's the scenario the silver squeeze Air Force trader is betting on. The question is probability. Which scenario is more likely given everything we know? And when I look at 5 years of structural deficits, when I look at inventory depletion of 65 to 72%, when I look at industrial demand from solar and EVs that's growing, not shrinking, when I look at supply that structurally cannot respond to price signals, the bullish case looks significantly stronger than the bearish case. But I could be wrong. The trader betting $9.5 million could be right. Markets humble everyone eventually. Now let me talk about how to think about all of this if you're watching this and wondering what to do. First, understand that silver is not a calm, boring asset. It moves fast. It overshoots in both directions. It can rise 30% in a month and drop 30% in a week. That volatility is silver's personality. If you can't handle that kind of price action, silver might not be for you. Second, understand the difference between trading and investing in silver. Trading means trying to time the swings, buying the dips and selling the rips, managing leverage carefully, and having strict risk management. Investing means building a position over time, holding through volatility. and focusing on the long-term structural thesis. The Silver Squeeze Air Force trader is trading, not investing. They're using 20 times leverage. They're betting on short-term direction. And they've already lost nearly $5 million doing it. For most people, the investing approach makes more sense. Accumulate silver during weak phases, hold through the volatility, think in years, not days. That's how patient investors capture the big moves. Third, understand that the silver market has multiple personalities. It's a monetary metal, a store of value, a crisis hedge, but it's also an industrial metal essential for technologies that are reshaping the world. Those two personalities create different demand drivers that can operate independently. Investment demand responds to fear, uncertainty, and monetary policy. Industrial demand responds to technological adoption and economic activity. When both are moving in the same direction, silver can experience explosive moves. When they're moving in opposite directions, you get choppy, confusing price action. Right now, industrial demand is structurally bullish. Solar, EVs, 5G, AI infrastructure, all of these are growth sectors that need silver. Investment demand is more variable, responding to Fed policy, dollar strength, and risk sentiment. The combination creates the kind of volatile but ultimately bullish environment we've been seeing. Fourth, understand the risk of fighting structural trends. The trader shorting silver is fighting a structural supply deficit that has persisted for 5 years. History suggests that fighting structural trends is expensive. You might be early, you might be right for a while, but eventually the structural reality asserts itself. Now let me address something that I think is really important about market psychology. When someone loses $4.79 million on a trade and then immediately puts on a bigger version of the same trade, that tells you something about their conviction. But it also tells you something about the danger of sunk cost psychology. Sunk cost fallacy is when you continue a course of action because of what you've already invested rather than because of what makes sense going forward. I've already lost $5 million, so I need to keep going to make it back. That thinking has destroyed more traders than any market move ever has. I don't know this trader's motivations. Maybe they have information we don't. Maybe their total portfolio is so large that $5 million is acceptable risk. Maybe they're hedging another position we can't see. But from the outside, it looks like someone who is doubling down on a losing bet because they can't accept being wrong. And that's one of the most dangerous patterns in trading. Now let me talk about what could make the short thesis work, because I want to give you both sides of this. The short thesis works if we get a significant global recession that crushes industrial demand. If the world economy contracts sharply, if solar installations slow dramatically, if EV sales collapse, then the demand side of the silver equation changes. The deficit might turn into a surplus. Prices could fall. The short thesis also works if the dollar strengthens significantly. Silver is priced in dollars. When the dollar rises, silver becomes more expensive for international buyers, which can reduce demand. A major dollar rally, driven by relative economic strength or safe haven flows into U.S. assets, could pressure silver prices. The short thesis also works if the Federal Reserve maintains or raises interest rates aggressively. Higher rates increase the opportunity cost of holding non-yielding assets like silver. They also tend to strengthen the dollar. A hawkish Fed could create significant headwinds for precious metals. Finally, the short thesis works if there's a breakthrough in substitution technology. If someone develops a way to replace silver in solar cells with a cheaper material that performs equally well, that could fundamentally change the demand picture. But these breakthroughs take years to develop and even longer to deploy at scale. So the short thesis requires several specific things to go right. Recession, but not the kind that triggers safe haven demand. Dollar strength, but not the kind driven by global chaos. Hawkish Fed, but not the kind that breaks something in the financial system. And no supply constraints mattering for the entire duration of the trade. That's a lot of specific requirements, and each one has significant probability against it. Now let me bring this back to what you should be watching going forward, because this story is not over. Watch the silver price relative to the $83.73 level. That's the average entry for the big short position. If prices stay above that level, the unrealized losses grow. If prices rise significantly, the pressure on the position becomes intense. Watch the COMEX and London Exchange inventory data. If inventories continue to decline, that confirms the supply thesis. If inventories suddenly start building, that would challenge the bullish case. Watch the gold-silver ratio. If the ratio starts compressing, meaning silver is outperforming gold, that's a sign that the catch-up trade is beginning. Watch solar installation data. Every gigawatt of new solar capacity requires approximately 105,000 to 110,000 ounces of silver. Growing installation rates mean growing demand. Watch for any signs of the short position being reduced or liquidated. On-chain data can sometimes show when large positions are being unwound. A liquidation of this position could be a catalyst. And watch the broader macro environment. Fed policy, dollar direction, inflation data, geopolitical developments, all of these affect sentiment toward precious metals. Now let me share some final thoughts on this situation because I think it captures something important about markets in general. Markets are ultimately a voting machine in the short term and a weighing machine in the long term. In the short term, prices can move based on sentiment, leverage, and positioning. In the long term, prices reflect underlying reality. The Silver Squeeze Air Force trader is betting on the short-term voting machine. They're betting that sentiment and positioning will push prices lower, at least long enough for them to profit. But the structural reality is the weighing machine. 5 years of deficits, depleting inventories, constrained supply, growing industrial demand. These are the weights on the scale. And in the long run, the weighing machine always wins. That doesn't mean the short trader will definitely lose money on this specific trade. They might time it right. They might get lucky with a macro shock. They might have the position sizing to survive extended drawdowns. But when you bet against structural reality, you're playing a dangerous game. And the losses they've already taken suggest that reality is starting to assert itself. The silver market is at a fascinating inflection point. We have a stubborn short betting millions against the trend. We have a structural deficit that shows no signs of resolving. We have industrial demand that's growing for fundamental reasons. We have inventories that are depleting rapidly. Something has to give. My view is that the structural forces are more powerful than any single trader's conviction, no matter how many millions they're willing to lose. But markets have a way of surprising everyone. What I do know is that this situation bears watching. The collision between leveraged shorts and structural supply constraints has historically produced some of the most violent moves in commodity markets. And when those moves happen, they don't give you much time to react. So whether you're bullish, bearish, or undecided on silver, pay attention. The setup is in place for something significant. And the trader who just lost $5 million and is betting another $9.5 million is providing a fascinating real-time case study in what happens when conviction meets structural reality. The question is, which one breaks first? I'll be watching this closely, and I'll update you as the situation develops. Because in markets like this, the next major move is often closer than anyone expects. That's it for today. If you found this breakdown valuable, hit the like button. It helps more than you think. And if you're not subscribed, now is the time. The silver market is moving fast, and you don't want to miss what happens next. I'm Mr. AG, and I'll see you in the next one. Stay sharp out there. The markets are volatile, but the opportunities are real for those who understand what's actually happening beneath the surface. And remember, the people who win in markets like this aren't the ones with the most leverage or the biggest positions. They're the ones who understand the fundamental forces at play and position themselves accordingly. Understanding beats speculation, patience beats panic, and structural reality beats stubborn conviction. Eventually. The only question is timing. And for the trader sitting on $9.5 million in shorts with 20 times leverage, that timing question is becoming increasingly urgent. I'll see you next time.